Yeah, without further ado, as I said, Jordan and I have been friends for over 10 years. We've kind of followed each other's paths as we've set up investment funds and been investing professionally in different ways. And we thought it would be interesting to kind of share our take on what we do and how it's similar and how it's different. So more or less, this is going to be an opportunity for me to sort of interview Jordan, ask Jordan about his journey, and then share that with folks within the Hosper network in what is hopefully the first of a series interviewing other fund managers who do things outside of mortgages. So to kick it off, Jordan, please let's start at the very beginning. Tell us who you are, tell us where you're from, how'd you get to running your own fund? Let's start there.
Sure. Yeah, so I'm from Burlington, Ontario, and that's where I grew up. And I was, I guess you could say like I was a jock as a child. I just cared about sports for the most part. That was my focus, and I love football. That was what I spent my number one priority in high school, if you were to ask me, would have been that I loved football. And then going into my last year of school, I got 2 concussions in the span of 2 days, and I had to take a year off school to recover from these concussions. And that was obviously a huge change, because before I was focused on sports, it kind of forced me to think, what is the next thing that I'm going to try to dedicate my life towards? And I'm just the type of person that gets like very obsessive with specific things, and then pretty much dedicates everything he has towards those goals. And so I looked around and thought to myself, okay, number one, I want to be a competitor. I want to compete in something that's highly competitive. And number two, I want it to be something where the rewards of being very good are strong as well. So I came across investing, became obsessed with it, and then pretty much just thought about how I could become a fund manager to be sitting in the seat that I am today. So I went to Laurier. That's where James and I met at Laurier. Laurier creates a lot of portfolio managers on Bay Street. They have a good program for that. So I went to Laurier, was a finance student, did my internships at Gluskin Chef, working for Ira Gluskin, and then had met a portfolio manager who used to work at Fidelity, but went to CI to run an investment group there called Cambridge Global Asset Management. His name was Brandon Snow. He also was a Laurier alumni, and reached out to him, got to know him. And then when I graduated, joined their group. So I was a tech, media, and telco analyst for 5 years. That was my focus, traveling around the world, meeting every tech, media, and telco CEO, which was a lot of fun. And then the last 2 years before starting this fund, I was a global small cap portfolio manager of a $1 billion global small cap fund. That fund was highly successful, compounded at about 18% annualized for those 2 years. And then got the opportunity from the beginning. This was the plan was really to start my own fund, my own strategy that would be just focused on long-term compounding. And so I met 2 individuals. Their names Jonathan Bloomberg and Sanjay Sen in around 2020. One of their largest positions of their fund, they run a $2 billion fund, was a casino company that was also a large position of my fund, the fund that I was a part of at CI. So I met them through just talking about that investment, and realized they could be an incredible partner for me to start my own fund, because they had the same long-term focus and focused on like owner-operator businesses, and they owned their business. And so I pitched them the idea to start Optimist Fund, and got to know them over the time of a year or so, and eventually they said, yeah, let's do it. So then I quit CI and worked full-time on starting Optimist Fund. Then come March of 2022, a few days after Russia decides to invade Ukraine, and we have the largest interest rate tightening cycle in the last 50 years, I launched Optimist Fund.
So we'll get to that. We'll definitely get to that. But let's start. I like to start with this question. When somebody asks you what is Optimist Fund, what do you say?
I say it's a global equity fund that's focused on finding underappreciated market leaders that are run by proven, exceptional capital allocators that have significant growth opportunity.
Okay, so
That is
that sounds simple in your mind. Simplified even more for me. For a simple mortgage guy like me, what simplified even more? What are you
so I
looking for?
invest
What do
in
you invest in? Yep.
public stocks in the developed countries in the world. So there's 23 countries that are deemed as like developed market countries. It's mostly Europe, North America, Japan, and Australia. So I hunt around the world for the public companies that I think are market leaders,
Hmm.
that are under, like, what they're doing is underappreciated by the market. So I think that the stock is currently undervalued based on what economic value they'll be able to create in the future.
Hmm.
They have to be run by proven capital allocators that
Hmm.
have a history of generating returns from the investments that they have made, that have significant skin in the game. So they either own a large portion of the company. Well, no, they have to own a good chunk of the company, and that we're not in the ninth inning of their journey. So I would not
Hmm.
focus, like, you could take, I don't know, there could be a business that had an incredible last 30 years, but they own the market now and there's no growth in the market anymore.
Hmm.
That CEO who ran that company for 30 years could be great, but that would not be an opportunity I would focus on,
Hmm.
because it is, their best days have kind of happened. I'm focused on businesses that they are like midway through their journey. They're not startups, they're still established businesses.
Hmm.
They have grown significantly, proven that the money they've invested is generating a return, but they
Hmm.
still have a lot of runway. Uber
Hmm.
is like a prime example of that. Uber is
Hmm.
a business that is, I guess, roughly 15 years old. So it's in large, like, public companies perspective. It's a young company, but it didn't start yesterday.
Hmm.
They are a market leader. They have 70%
Hmm.
market share in pretty much every country that they're in. They are run by a very strong CEO with Dara Khosrowshahi, who owns a significant amount of stock. They have proven unit economics, and they have still significant growth runway ahead of them. So that is what I'm focused on. All my time is focused on finding those type of leaders for phenomenal businesses that is underappreciated.
Let's talk. So let's talk about unit economics. Like let's I love both answers of what is Optimist Fund. And I was kidding. I followed you with the explanation, but I liked even more the simplified literal example of a type of company that you follow, research, know in and out, and
Yeah.
invest in. So let's talk about unit economics, because that's obviously super important to what you do. Can you give me a
Yes.
same simplified example of unit economics?
Yes. Yes. So Uber, let's use Uber, since everyone likely can familiarize themselves with Uber since it's such an important product. Uber is a business that historically has not made money, in the sense that if you took Uber's income statement, it would show that their expenses are greater than their revenue. And that, obviously, like, the first glance would be, oh, that must be a bad business. And if you have an approach of looking at unit economics, what you can find out is that even though a business might not be losing money in aggregate, it might actually be a really good business. And that's because it has great unit economics. So, for example, if Uber were to launch in Toronto, they would spend a bunch of money to subsidize drivers, to get drivers on the platform, and then they would spend a bunch of marketing dollars to get customers to download the app. That would obviously make them lose money up front to get everyone together on each side of the network. But then if the person was consistently using the app for the next 10 years, and you didn't have to repay to get those people together, that initial investment would then be paying you profit into perpetuity. But that
Hmm.
first year, you don't make money. Second year and beyond, you make a lot of money. The thing is that Uber did that in Toronto, or like one specific city, and then they said, well, why don't we do this in Mississauga? And so then the profit that business then generates in year two they take that profit and they redeploy it into growing in Mississauga. And then if the following year, then they have Toronto's profit and Mississauga's profit, they say, why don't we go to Vancouver? So they take that profit and they go to another city and build out scale. And so this is why Uber didn't make, like, if you were to Google Uber and look at tons of newspaper reports of them over the last like 6 years, you'd see a lot of people saying, will Uber make money ever? Is it a good business ever? In fact, it was actually like, it is a good business and they're very profitable in many, many cities around the world, but they would just always take that profit and redeploy it into another growth area to maximize their long-term profit. And so that's really the crux of like unit economics. The reason why this is like so important is like, if the investment, like let's say you guys are real estate guys, a lot of you. So let's think that you buy a building. So you buy it at a 5% cap rate. So the first year you give someone $1 million, the next, and then you're going to get back 50 grand that year. You're actually out 950 grand.
Mm-hmm.
But you know that building is like your asset and you're getting that cash. Well, in Uber's example, their income statement would just say they lost 950 grand because you wouldn't capitalize the investment they made as an investment. Because that's the hidden value of a lot of like internet-centric businesses, is that their investments don't get capitalized. It's not a retailer where you have to buy a bunch of inventory that gets capitalized. It's stuff that ends up being in your operating expenses, so the profitability can be hidden. But that's uncovering now. Like that's why right now is such an attractive time to be investing in a lot of these digital oriented businesses, because we went through a situation where there was many years from like 2010 to 2021 where people just said, just grow as fast as you can and we'll believe the unit economics are good. So for some of you, they might be good. For some, maybe they're not good, but we'll believe it. And then last year in 2022, it went from, we're not going to believe anyone is deploying capital effectively. So if you were deploying tons of capital to grow, maybe it was adding value, maybe it wasn't. But in 2022, we're just going to assume it wasn't adding value. And so Uber and some of my other holdings, like a DoorDash or a Carvana or a Wayfair, these businesses then in 2022 right-sized their cost structure and then all said to themselves, okay, we're going to slow our expenses. We're not going to reinvest our profit into another activity to show everyone that we have a really healthy business with expanding margins and like a very attractive return on capital, and just show people that we have been deploying capital in a diligent way. And that's kind of the opportunity right now, is that the stocks are like, 2022 was, everything was bad. 2023, Uber results have been incredible. Carvana results have been incredible. Wayfair results have been very strong. But the stocks have only re-rated like 10% of what I think they're going to over the next 5 years.
Mm-hmm. So let's talk about, so now that you've kind of explained to the audience, you're focused on growth companies, care about management, evolved management, top level management, and you've talked about how unit economics are more important than actually the profitability of the company, because the profitability is implied.
It's the precursor. Great unit economics will drive long-term profitability.
So how did you either arrive at that niche, or how did you decide that's the niche that you want to focus on?
In 2013 and 2014, I spent a lot of time in software, in the software as a service industry. And I spoke to many management teams, and they were investing a lot. They were investing more capital into their business, and they weren't profitable. And I asked them, well, when are you going to scale your profits? And they said, well, if we can hire a sales guy and he can pay for himself in a year, we'll just keep hiring more salespeople because we're getting 1-year paybacks, and then we get this annuity stream.
Yeah.
And I was like, that's kind of strange. And then I talked to everyone else. I talked to tons of other portfolio managers and analysts in the investment community at that time, of like asking like, what do you guys think about this? And everyone just said like, they're not profitable. It's bad business. And it made me realize that it was like a really big opportunity where just a lot of really good companies that had sticky customer relationships that were very valuable people thought they were bad businesses, but it was just they were just redeploying all of their capital into growing more customers that were going to give them more profits. So it was like in 2013, 2014, I just identified this like arbitrage opportunity. But then fast forward from then to 2020, 2021, like that really got found out. And then a lot of these companies had very exceptional performance. And then it was like over appreciated. It was like people were like, yeah, I believe that they're going to grow to the moon forever. And so now it's like completely reversed again. So we're back to like even lower than 2013, 2014. So the opportunities again has come back right into my lap.
Right. So we didn't really touch on this, and I, obviously I've known you pre-Optimist Fund since the launch of Optimist Fund. As a client of Optimist Fund, how did you determine? So how do you determine how many holdings is the optimal? And I guess I know I've asked you this question before, but for the benefit of the audience, like how frequently are you rebalancing the holdings?
Yeah, so I own 15 to 25 securities. As of right now, I own 16 securities. So that is a concentrated portfolio, especially for typical public equity funds. Like that's my top 10 holdings is 80% of the fund. And the reason why it's 15 to 25 is it is concentrated enough that my top 10 positions will be the driver of the returns of this fund, but no one position will drive the performance of the fund over a long period of time. And so there's a lot of funds that have like 50 positions and the biggest position is like 3%. And what I realized in that environment is that your best ideas don't actually, you don't own enough of them. So it really dilutes your returns. You end up having much more ETF-like returns. And so I just believe much more in like, if you want ETF-like returns, just buy an ETF. Like if you want something that's going to be like 1% better or worse than an index, just buy the index. But if you want to focus on a particular subset, like many people could look at my fund as an additive to like you would likely be better off, in my opinion, instead of owning a one specific fund by a large mutual fund company, it could be better off owning 90% in an ETF and 10% in a highly concentrated fund like mine.
Yeah.
So that's the reason why I went for the concentration element. But at the same time, like this fund the success of the fund is not going to be driven by one stock.
Yeah, and that's a kind of the cool first divergence. Well, there's many divergences from what we do, but I'm looking for the opposite, right? We're trying to kind of within the mix structure, we're trying to create almost like an ETF because there's not really an ETF for direct mortgage investments, right? So we don't really want to consider mortgage in the fund to be best or worst ideas. We just want everything to be vanilla. Chalk it as full of vanilla, diversify it to the point where, I'd love to have every loan be less than 1% of the fund.
Yeah.
Because we don't want concentration, but then it gets to the point where it can be too diverse that you're, if we're managing $80-90 million in a fund, we don't want, $50,000 tickets. We don't want that much administrative in and out. Okay, so that's.
But it also makes sense too, because the profile of our funds are different, right? Like I'm in a growth-oriented equity fund, so I'm all about capturing asymmetry. Like what's going to drive returns over the next 5 years is like Uber, DoorDash, and Wayfair all going up 5-fold, and maybe 3 of my holdings aren't good and they're down 20%. But because of those 3 holdings together doing exceptionally well, the overall fund can do really well.
Yes. Yeah. So
it's all about that asymmetry. It's like you get multiples of the upside, right?
So the other thing that I don't envy in your regard. So for us, the duration of the investment that we hold is pretty much drives itself. Obviously, we make decisions when to renew, when to extend, and so on and so forth. But as a client pays us out, we take back that money and we reinvest it in another vanilla loan. And that's sort of easy for us. Now you got to make the decision. You got to make the decision every day, essentially. So what's your process for rebalancing, for when to buy more, when to sell? That's something that's again a big divergence from what we do.
Yeah, so it's all about the risk reward profile of the investment. And so I have like an upside case for all of my holdings, and I have a downside case for all my holdings. And so I look at where each of my holdings stands from like, okay, what's the upside over the next 5 years? What's the downside? Is this one much more attractive than the other? And thus, okay, let's have a higher position in that fund, in that holding. And so everything's about upside, downside. The uh, the rebalancing would happen just when something actually has changed. Either the stock price has moved dramatically where the upside and the downside risk reward trade-off doesn't make sense anymore,
Mm-hmm.
or something else happens that makes another opportunity much more attractive, in which case I have to sell something to be able to add to it. So it's
Mm-hmm.
really just maximizing return for the risk that we're taking.
Mm-hmm.
But I'm not like trading all the time. Like that's one thing I want to make sure people understand. Like I've added 2 new holdings in the last 15 months, like 2 new companies. Um, so I'm looking for companies that I hope to own for 5 to 10 years.
Mm-hmm.
Um, Obviously, it doesn't always the case because different opportunities come up. But I'm not like, oh, next quarter this is happening. Okay, own this for a month and sell that. Like I'm an investor. I'm not a trader. I'm really trying to find the Amazons of 10 years ago.
Yeah.
That's what I'm focused on.
Well, what I like about, being able to watch each other's journeys is, I remember our conversation at one of your old place, like one of the places you lived previous, when we talked about Uber. This is during the referral code days, right?
Yeah.
You could
Yeah.
refer someone, get $20, get a free ride. We were talking about the price, and I remember you specifically saying, eventually it will be the same price as a taxi, but it won't matter.
Yes. It won't matter.
And
It won't make a difference.
and it's just kind of cool when, to see from there then to now, and to understand that, yeah, Uber was something you've been looking at. I think that may have been 5 years ago, right?
I
Um,
have been
so
I've been obsessed with Uber since it came to Toronto. Like
yeah,
I'm have been very interested, and then last summer I became exceptionally obsessed with it because it went from $60 to $20 and became exceptionally cheap. Um, and so yeah, it's a fantastic business that is still very early in its journey.
hmm. So let's talk about that. So you alluded to, obviously the time we do things is in many cases is the time that we do them.
Yeah.
I talk about this with people on the real estate side. When you bought your house is just when you're ready to buy a house. So you can't, and when you're in a position to start a fund is just when you're in that position. So obviously,
Yes.
the global environment that was happening with the war in Russia and Ukraine, the tightening cycle, monetary tightening cycle that happened as a response. To talk to us about the obviously, share about the first year, because I know it was a tough first year, and I know that, I think you told me, looking at the numbers, what, down 50 in the first year and then up 80 year to date this
Yeah.
year. So these are obvious. There's a couple things to unpack there. One,
Yeah.
what was that like in the driver's seat? And B, talk to us about that volatility. Is that to be expected? And unpack away.
Yeah. So that was that yeah, that 2022 was very it was a year where a lot of 1 in 50 year events happened. And so like I told you before, right? Like I'm focused on finding businesses that I believe to have like Amazon like opportunities over the next 10 years, right? So um I thought that a lot of that happened in 2022 after several companies like a Carvana and a Wayfair, which are 2 online retailers. Carvana's online for used cars, Wayfair's online furniture, were already down 70% or so when I started buying them. And I, at the time, thought these are attractive entry points. And then interest rates went significantly higher, inflation went significantly higher, and all of a sudden people despised any business that was reinvesting their profits into the income statement and thus looked like they were like a bad business. If you just on the surface said, "Oh, what's the earnings?" and they said like, "Well, they lost 500 million last year." Everyone just ran to the door. But uh, let me be clear that I it was insane seeing these companies crash, but I just kept adding. So let me can I share my screen? I'll just show you one.
Sure, you should be able to. Let me know if you have.
Yeah, let me share my screen here. Share. Oh, oops.
All right, we can see your joined teams. There we go. Yeah, I can
There.
see
Okay,
that.
so yeah, so 2022 happened, and Wayfair, Carvana, two businesses that I've followed for the last, I don't know, 5 years or so. No, incredibly in depth. Bought a little bit when we launched. Stocks went down. Bought more. Stocks went down for reasons that were cyclical and not structural. Like they do not have a long-term impact on the free cash flow generation this business will produce over the next 5 to 10 years, and so kept buying, which obviously made it so that our 2022 year was very weak. But at the time, and you can go back to my letters and read them, it was, this is an incredible investment opportunity. You could have bought Amazon down 85% in 2002, and then it would have went down another 50%. And like in periods of incredible levels of panic, this kind of volatility happens, but I made sure that we use it to our advantage. And so if we just look at this year, 2023, what have we seen? 2022, everyone was scared. Wayfair is going to go out of business. Carvana is going to go out of business. They're bleeding money. They're not good businesses. In 2023, Wayfair growth has returned, free cash flow generation, like cash earnings has returned, growth's accelerating. Carvana, their profitability has returned as well. And obviously you can see that the share prices have had a very strong 2023, but still it's a fraction of what the next 5 years can be. And so in periods of like significant market panic, and this is one of the reasons why I really was adamant on like starting my own fund, is in periods of market panic is when there's enormous investment opportunities. Enormous. Carvana went to $3.50. It's $35 today. Like we bought all the way down from $100 to mid-single digits. Our average cost on Carvana is $25. Now it's $35. But over the next 5 years, I believe Carvana can be a $600 stock. And to be able to weather these volatile moments, to take advantage of them, if you have a multi-year time horizon on your investment, they can be huge opportunities. So we're on the turn right now of benefiting from the hard decisions that were the appeared hard decisions that were made in 2022.
Mm-hmm.
We're going to benefit a lot from them over the next couple of years. So I feel very good about it. But at the time, yeah, it was the toughest part was just explaining to everyone that these were amazing investment opportunities, because as you can imagine, Carvana went down 90%. People were like, is this business going bankrupt? I was like, no, it's not. We should, like, we're buying more. Not everyone like that scares some people, but that's my job. My job is to figure out what's the truth, where are the best opportunities run by the best management teams. Carvana's founder owns 40% of the company, and allocate capital towards those best opportunities. So that's how I thought about things.
Yes, that's where I said I don't envy you, but I suppose, I suppose difficult things become easier the more you do them, and in many of our jobs, you just get practice at doing difficult things.
Yeah, well, it's also like I study these companies 24/7, right? Like I just, this is what I do 24/7. And so when someone starts saying like, oh, this business doesn't do, it's like, well, I've been looking at this for 5 years in depth. I've already asked all those questions. Like
Yeah.
all those things I've already kind of went through. So I just like, obviously things can change. So you need to like make sure that the things you knew previously are still true. But when you're very focused, like I said, 80% of the fund's in 10 holdings. Like I'm very focused on a few opportunities. It allows you to be able to, I guess from the outside, it looks like have courage when people are petrified.
Mm-hmm. Mm-hmm. Yeah, I can relate. We the way you look at specific companies, we look at many properties,
Yeah,
right, to evaluate, but the process is always the same, and the appraisals are always the same. So it becomes very easy to, um, have an appearance of patience or an appearance of courage, but it is just, the process, and that you kind of got to stay the course with these things. I'm often caught saying, the best way out is through. Sometimes the panic leads to the not best decisions when it comes to investments.
of course.
Um, you know what,
But
Jordan, I'd
that's
love
what
to
you
put.
did. But you've done that. You bought. You bought in the dip.
Well, so
took advantage of the
let's.
opportunities.
That's actually, I'd love for you to, because I've been this whole presentation, or this whole chat. I should call it chat. It's really what it is. I've been trying to correlate or compare what you do with what we do, both from my own understanding, but also to relate it to the folks we have listening, tuning in, that are going to know a lot more about how Hosper operates as a MIC fund,
Hmm.
which is going to be way more passive. Kind of like, we're the leadoff hitter that's trying to hit singles, and you're the heavy hitter coming in and trying to hit the home runs.
Hmm.
So, put in your words for me. How is what we do similar, if you can find any similarities, and how is what we do different?
The entirety of what we do is just finding undervalued cash flow streams. Like you find undervalued cash flow streams that are fixed,
Yeah.
and you think that they're mispriced, and that's why the return you're getting is it makes sense to make the investment.
Hmm.
I am looking for undervalued cash flow streams of businesses that are not, the cash flows are not fixed, but it's
Hmm.
what the profit of this business is going to generate over the next 10 years.
Hmm.
So it's really the same thing. It's just figuring out cash flows. So for you guys, it's understanding your properties, I assume, understanding the people that are borrowing. And for
Hmm.
me, it's understanding the industries of which the companies are addressing, the competitive advantage of the company, the quality of the management team, what drives them, how they'll operate in different environments. But it's really at the same time just, present value of cash flow streams.
Right. And as we talked about this, George, why we want to share the comparisons in this with those who we know to be interested in and want to learn about investing, and interested investors, active investors, is this what we're talking about, and the difference is diversification at the end of the day, right?
Mm-hmm.
You want to find
Yeah.
these undervalued cash flow streams, and you want to make sure you're at the same way that you diversify, uh, and you don't want any one holding to be the determinant of your success or failure.
Mm-hmm.
I think for investors, we shouldn't have one investment type be the determinant of our success or failure. I know you and I both have probably a higher than recommended concentration in our own, in what we do,
Yeah.
which is, I suppose, similar to your managers, the managers
Yes.
you value.
True.
But when I think about, and I'm often asked this question from my clients, and maybe you're the same, is, you know, how much diversification, how much should we diversify? So I kind of like your approach with, you want the diversification to be enough that your success or failure isn't determined by one thing, but
Yeah.
you don't want it so diversified that it's none of them independently are meaningful.
Yeah. You could just, buy some sort of big like if you want, you could just own, I don't know, you could just own a global markets ETF or something if you want to diversify across 2,000 different
Right,
companies.
right, right. And I find that I don't want to generalize here, but I've with about 500 clients at Hosper, right? And of course, many of them are real estate centric. Many of them like private market investments,
Mm-hmm.
because they're looking to, beat the traditional returns. And
Mm-hmm.
when you go into, small, when you're not competing with the billion-dollar asset
Yeah.
allocators, there's sometimes outsized return just because there's scarcity of that product,
Mm-hmm.
um, or just scarcity of, in many cases, private market, right? As we know, is who do you know? A
Mm-hmm.
lot of these aren't publicly, like your fund nor my fund is publicly traded anywhere.
Mm-hmm.
You have to,
True.
okay, so I want to respect the time here. I want to wrap this at 5:45. So I think the
Yeah.
best way to spend the last 5 minutes. I loved the explanation of Uber. It really helped it sink in. Can you pick one more of your holdings? Let's just talk about it. Let's talk about what we
Yeah,
like
sure.
about it.
Let
Let's talk about how
me
you look at it.
let
Pick
me
one.
yeah, let me share my screen again here. I want to show you alrighty. Let's move that guy over there. All right.
Yeah, we're
I'll
good.
get to
I can see that. Yeah.
Yeah, let's go Carvana. So Carvana, anyone here who has bought a used car, or a car for that matter, has dealt with the dealership experience. And what is the dealership experience? You buy a used car, you might do all the research online, all on Auto Trader. You might be like, I am buying this exact 2018 Ford F-150, and you go to the dealership, you take the test drive, and then you can't just give them money. You literally can have a suitcase full of cash and just say, take the cash, give me the keys, and I'm out. Can't happen. What do you have to go through? You got to go through the finance department. They try to sell you all these different products. It ends up being that you're at the dealer for several hours because of all the processes they need to get you through, all these paper signatures you need to do, the financing process. All of it is very, very antiquated relative to a lot of other commerce categories. Carvana's CEO is a guy named Ernie Garcia. His dad runs a top 20 US automotive dealership in the States. And he worked at it and realized, like, how do we make this process better? Like, how do we make it so that when people buy a used car, they don't leave being like, did I just get ripped off? Like, I feel like this was like 5 hours when it could have been done in 20 minutes. And so he convinced his dad to fund him to start Carvana, which was like the first online used car retailer in the US. And so what they did is that you'd go on their website, you'd see the inventory that they had. They would identify all the flaws in all the vehicles. They give more information than you would ever get about the vehicle you're buying that you would get going to a car dealership. They provide it online. They would do integrated financing. So you would, on the app, fill out all of your information and they'd say, okay, you're approved for this loan. Then you'd buy the vehicle, they'd deliver it to your house, you'd have it for a week, and you decide, do I want this or do I not want this? That user experience was like ordered like significantly better than the user experience of traditional used dealers. And that's what drove the business from being absolutely tiny to growing 100% a year from really 2011 to 2020. So as you can see from this period, this was phase one of the scaling of the business. They grew over 100% a year. Their gross margins went from, they were losing money on every car because to build scale at the beginning, you can't like start a dealership tomorrow and sell 2 cars. You won't make money. So they started losing money on every transaction to then getting to 15% gross margins and going from burning tons of free cash flow at the beginning to being free cash flow break even. So during this period, they had many different markets. The first market was Atlanta they went from 0 to 3.5% market share, went from losing money to 4% EBITDA margins and being cash generative. And then they'd take the profits from that market and they'd open another market and they'd open another market and they'd expand to be a national retailer. So this was very much something that people were interested in. And I watched this company, I didn't own this company in 2022. I watched them, I met with them. I was very impressed with the product offering and their execution, but I was always somewhat questionable as to what the long-term economics would look like and whether or not their balance sheet was strong enough, to be honest. Then, so this stock went from $10 or it was a $15 stock roughly when they first went public, and it was a $360 stock at the end or in the middle of 2021. This was an absolute like resounding success. Then 2022 happened. This is what I like to call phase 2. 2022 was a very unusual time for the used car market. Interest rates went up. There was not enough new cars being sold. So the amount of trade-ins entering the market was a lot lower, which made it so that there was less used cars to actually be bought. This made used car prices skyrocket, but affordability was horrible as well because interest rates shot up at the exact same time. Because of this, Carvana then was expecting to grow like 50%. And then they realized, oh, we're not going to grow 50%. We might only grow 20%. And so they needed to restructure their cost to adjust for how much less they were going to grow. And this was a period where people got very scared. At the same time, interest rates were increasing. Everyone was selling equities. The markets were tanking. So anyone who owned Carvana was just hitting the sell button. And that's what drove it from, it was $200 at the beginning of the year to at its low was mid $3, which is truly insanity. It was just like, it was absolutely insane, frankly, that happened. But what did they say they were going to do within that year? They said, we're going to restructure the costs. We're going to shrink our units to get as profitable as possible to show you guys that we have a very economic business. And then once we've maximized our profitability and showed everyone we have a very good profitable business and a strong economic model, we're going to return to growing and becoming the largest used dealer in the US. And right now, and previous to this, they were the number 2. And so what happened? 2023, they shrunk their, what's happened this year so far? They shrunk their costs. They got to adjusted EBITDA profitability. They're now cash flow positive. Their units have stabilized. Their EBITDA margins are now mid-single digit and ramping to be higher. So their profitability is just is skyrocketing right now. And we're just in the next year going to start growing the business again. And when that growth comes through, it's going to come at increasing profitability, which is going to, in my opinion, the view of Carvana is going to go back to the very favorable view. When it was a $360 stock and people thought Carvana was going to be selling millions of used cars a year and making tons of money, and then they lost that view in 2022. Now we're rebuilding that credibility, and so that's why I'm so excited about this position on a go-forward basis, because all the things people criticize them for, they fixed, and now we're going to start experiencing tailwinds.
Very cool.
That's my largest position today.
Cool. Very cool, Jordan. All right. So, thing I'd share with everyone, Jordan's a frequent attendee of Hosper events too. So come out to, the next Hosper event that we host, and we generally share the invites on our newsletter. So keep an eye out for those. And if you found this interesting, you'll have a chance to talk to Jordan in person. I guess that's the point. We're just trying to pass on the information that we have, have thoughtful conversations, and thank you all for joining us in that. So, Jordan, I think that's a wrap. Right?
Great. Well, I enjoyed the chat, and yeah, if anyone has any questions about any of the companies I talked about, or just growth-oriented companies in general, feel free to email me at jordanmcnamee@optimistfund.com. I'd love to chat about it.
Very good. All right, pal. Nice chatting.
Great. Take care.